In this video, I will explain what is likely coming next for markets, some major catalysts, and the dates in which these will take place that could cause a reversal in markets to the upside or cause stocks to fall even more. Here in this video, I will share my expectations. None of this is financial advice and take it with a grain of salt, but I will share with you how I'm currently seeing markets, how we're set up heading into these catalysts, and in fact, why I think they could be positive. Now, don't get it twisted. If I'm wrong and these catalysts come in bad and these dates are really just not good, then markets are going to fall a lot more. And I will share with you the important level you should watch for on the S&P in case of a disappointment. So with that said, ladies and gentlemen, this is your market update for January 11th, 2025. It is Saturday, so a lot of this is just upcoming catalyst, where markets are currently at as far as sentiment. And let me tell you, they're really, really bad. Let's actually start there. The markets from a sentiment and positioning perspective are very negative. You could see the S&P is down about 4% from all-time highs. The RSP is down almost 8% from all-time highs. But that's kind of like not representative of how weak markets actually are right now. First and foremost, there's three indicators that I like to look at to kind of judge where markets are at. Okay, fear and greed index over on CNN, just as a broad kind of brush stroke, is very negative. You're almost in extreme fear. You're at 27. If you drop 2 more points, you're going to be in extreme fear. Whether you're in the bottom percent of the fear barometer here or you're in extreme fear, doesn't matter. Point is, markets are extremely negative. In fact, you can see how negative markets are by the percent of stocks trading above their 50-day moving average. And this is where I say the markets from an S&P or even an RSP perspective, the actual indexes are not really representative of the weakness we've seen under the surface in markets, because you are only at 28% of stocks trading above their 50-day moving average. 72% of stocks are in an active decline. Back on August 5th, of 2024, when you had the yen carry trade blow up, the markets, the S&P closed down 3%. It was down like 6% at one point. You almost had your first circuit breaker since COVID, and that's where the markets halt for 15 minutes to kind of let people catch their breaths and to relax a bit. And then the markets halt down 15%. That actually happened in a single day back, I think it was March 13th. Of 2020, you had 2 circuit breakers back to back. The world was basically ending. Now, if you get a circuit breaker, that's really bad, and that's where we were on August 5th. But you only hit a low of 30%, almost 31% of stocks trading above their 50-day moving average. So you are even more negative now than you were on August 5th. The S&P was down almost 10% on August 5th. So the S&P is down less than half of that, but yet internally markets are even worse off today than they were on August 5th. Yeah, that's rough. Back in April, the S&P was down over 7%, and you hit a low of about 27% of stocks trading above their 50-day moving average. So you're virtually down to your April 2024 correction level. The S&P was down about 7.5% at this time. You're basically down there as far as, what's happening under the surface in markets. That's pretty damn negative. And not too often during a bull market, you see sentiment that is this negative on the AI Investor Sentiment Survey. Bullish investors at 34.7%, neutral at 28.0%, and bearish at 37.4%. Bearish investors are 3% higher than bullish investors. Okay, this is almost a 1-year bearish high. And you're almost down 20% on the bullish side from your 1-year bullish high. You're down 3% from your historical average. This is about as negative as it gets during a bull market. And that's why I think for the upcoming catalyst that we have next week and on January 20th, we're actually set up in a good way because we're so negative. I mean, you need even worse news than markets are currently expecting to continue to fall. Could that happen? Absolutely. But I think at this point, we're expecting super aggressive tariffs. We're expecting higher inflation. We're expecting the economy is just going to continue to be red hot, fueling some inflationary aspects, when there's a good chance that things are not going to be as bad as we think. In fact, we'll talk about this a little bit throughout this video later on. This headline came out a couple of hours ago. It says Trump is planning 100 executive orders starting day one on the border, deportations, and other policies. It says here that allies of the president-elect have been preparing a stack of executive orders that Trump could sign quickly on a range of topics, from the U.S.-Mexico border clampdown to energy development to federal Schedule F workforce rules, school gender policies, and vaccine mandates, among other day one promises made during his campaign. If you control F and search this article, there's nothing in here about tariffs. And that's an interesting point. We'll discuss a little bit more throughout this video. And I will give you a rundown of all of your data points for next week. On Monday, you have consumer inflation expectations. We are expecting this will rise to 3.1%. Part of the reason why Friday was so rough was, yes, the jobs report, but it was also the 5-year and 1-year inflation expectations that skyrocketed well above expectations. I think why this happened is really because of tariffs and the expectation that tariffs cause inflation. Not that people are actually seeing inflation right now. I don't think people are looking around and saying, wow, prices are just going crazy. They're continuing to rise. I don't personally see that out in the economy, but I think it's just the expectation of tariffs that will cause prices to go higher. But we don't know what tariffs are going to look like, and we'll get into that in just a moment. On Tuesday, we have PPI. This is Producer Price Index. This is like, Dell or Apple's prices, right? How much are their costs going up, essentially, is what PPI is. We're expecting 0.3% on a month-over-month basis for the headline. Last month was 0.4%. So you're actually expecting a deceleration there. Core PPI is expected to come in the same as last month. Last month was 0.2% month over month, and you're expecting 0.2%. And core PPI year over year is expected to actually fall from 3.4% down to 3.2%. So PPI looks pretty good, if I were to say so myself. The TIPP Economic Optimism Index is expected to rise on Tuesday morning at 10 o'clock in the morning. That comes out. Last month was 54, expecting that to rise to 55.1. And the NFIB Business Optimism Index is expected to fall from 101.7 down to 100.8. You also get a speech from Fed Williams, and it looks like Fed Williams is trying to kind of cozy up to the Trump agenda. It looks like some people are kind of saying Williams looks like he wants to take over for Powell about 18 months from now when Powell's contract with the Fed expires. Now, on Wednesday, this is your big catalyst, like the biggest catalyst, okay? You get CPI. That'll come out at 8:30 in the morning. Core month over month last month was 0.3%. We are expecting 0.2%. So you are expecting inflation will decelerate, will slow down, okay? Now, 0.2% times 12 is 2.4%. That's still above the Fed's 2% target, but it's a big difference between 0.3%. 0.3% times 12 is 3.6% on an annualized basis. So you do not want another 0.3% number. That's not going to be good. 0.2% would be a really good number to get. Now, core year over year is expected to remain stable at 3.3%. Last month, it was at 3.3%. Excuse me. And then your inflation rate month over month is expected to remain the same at 0.3%, the same as last month. And year over year is expected to actually rise from 2.7% to rise to 2.8%. Overall, you're not expecting super hot inflation data. Given kind of what the markets are now expecting for inflation, that inflation is going to be moving higher, I think a benign inflation report would be good news. A lot of people assume that a strong labor market automatically means higher inflation. That is not a 100% guarantee. Now, government spending and supply issues affect inflation. That's what causes inflation. A strong economy can kind of amplify that, right? Growing wages, people are employed, they're spending money. That can amplify inflation, but it doesn't in and of itself cause inflation. And that's why I stressed last week that the jobs report, doesn't necessarily guarantee that we're going to have strong inflation numbers, right? That's not a guarantee that some people drew. So first big catalyst, January 15th. If CPI comes in lower than expected, or even meets expectations, comes in maybe on the low side of expectations, that's going to be a huge catalyst, because the last thing you want is a weakening economy, a weakening labor market. We don't have that. Apparently, things are fine in the labor market. If things are fine with inflation, then we really don't have a problem. Okay? That's why CPI is important. You can have a strong labor market and low inflation. That is possible. Doesn't seem like people think that's possible, but it is a possibility. We had that for 25 years before our recent, couple of years of inflation pressures that we have seen recently. We will get as well at 8:30 in the morning on Wednesday, New York Empire State Manufacturing Index. You will get Fed Barkin, Fed Kashkari that will speak right after the CPI report around 9 o'clock in the morning. Fed Williams that speaks again at 11 a.m. Fed Goolsbee that speaks around noon on Wednesday. Thursday, you will get retail sales month over month, expecting 0.5%. Last month was 0.7%, so that would be somewhat a deceleration from last month. You will get export prices month over month and import prices month over month. Initial jobless claims that are expected to rise to 210,000, but you're in a very low place. Last week, you came in at 201,000, again, really suggesting the labor market is doing just fine. And you will get Philadelphia Fed Manufacturing Index. Now, CPI is going to be the big catalyst, but retail sales can definitely move things depending how they come in, especially in regards to the CPI report. If the CPI report is weak and retail sales are good, that's probably going to be a good thing for markets, right? Now, if inflation is hot on Wednesday and retail sales come in hot, then the narrative continues. You will get Philly Fed data, CapEx index, employment, new orders, and prices paid, with a big focus that will be on prices paid, because we've seen with the services PMIs, the prices paid component really skyrocketed last month, and that's just expectations of higher prices. So it doesn't mean that prices are rising. It just means people are expecting higher prices. And that's some data we reacted to last week that was negative for markets. You will get business inventories and the NAHB housing market index coming out as well on Thursday. And on Friday, you will get building permits and housing starts, capacity utilization, industrial production, manufacturing production month over month, and year over year. So you really get a lot of data coming out next week, with the big data being CPI. Again, with markets this negative, you really need to see a hot CPI report next week to get even more negative from here. And trust me, if we do get a hot CPI report next week, we're in for a bit of a problem. Now, I personally think we're probably going to come in lower than expected on the CPI report, because the last 2 months, we've seen shelter inflation start to decelerate. Okay, if we see that again, with shelter being the largest component of CPI, you should get a surprise downside number to inflation, okay, to CPI. If that happens, then we can start to talk about the bull market recovering. And I think that could be the first big catalyst that could cause that. Now, the second big catalyst that will be coming beyond CPI is Trump's inauguration on January 20th. Now, there's news out here in the last couple of hours that Trump is planning 100 executive orders starting day one on the border, deportations, and other priorities. So you may know faster than not what the tariff picture could look like. Although, if I word search this article, there's no mention of tariffs at all in this article. Okay, there's none. So I think the markets want clarity. If we get clarity on January 20th or the 21st, that's going to be good. Now, I think we're setting up for a buy the news kind of situation. It seems like everyone's selling the rumor, and we could buy the news coming after January 20th, especially if we get an update on tariffs. Now, baseline, most people are expecting like a 20, 25, 30% blanket tariff. Wall Street is for sure expecting that. If we get, let's say, a 10% blanket tariff, then we may be a little bit too bearish right now on tariffs and what tariffs will mean for inflation. After all, even the Fed themselves are expecting tariffs will cause inflation. Tariffs are a one-time boost in prices. They're not long-term inflationary. Okay, so think about it like a CPI report or two could come in hot, but it doesn't tend to lead to, continued hot CPI reports. Okay, now a 10% tariff is lower, I think, at this point than Wall Street is expecting. I think a 10% tariff probably happens. Now, you may not see a blanket tariff. You may see certain industries that get tariffed. If we don't see a blanket kind of 10% tariff on everything, instead, it's industries that maybe are not very important to the U.S., that would be the best case scenario. Okay. And if that were to happen, then I would expect people are really going to throw out the window the whole tariffs are going to cause inflation thing. Imagine that. Imagine January 20th, Trump tariffs like car parts, or he tariffs, farm equipment or whatever, it is that is not systemically important to our economy. Then people are going to say, that's all? That's all we're getting from tariffs? Oh my gosh, inflation is no longer going to be this issue. And then the Fed's going to say, yep, the recent tariffs we have seen do not seem to be inflationary after all. And then markets are going to rip higher on that. Now, there is the off chance that Trump does opt for like a 25% blanket tariff on everyone, especially China. That may be a bigger issue. Then it's kind of wait and see mode to what that does to inflation. So I actually think that January 20th is probably going to be a positive catalyst for markets versus a negative catalyst for markets. Because at this point, I think expectations are really high for tariffs, that we're going to get some extreme tariff policies that are going to, cause a big round of inflation. Even the Fed believes that. I don't think Trump wants to destroy the bull market. I don't think Trump wants to destroy the economy. And that's kind of the basis of my argument. Now, if he does want to destroy the economy, if he does want to get, quote unquote, showed up by Biden, that's fine. I just don't think that's a part of Trump's personality. And this is more of a character gauge or judgment. I don't think Trump wants to be looked at as the guy that preceded Biden that destroyed everything. That Biden had 2 years of the S&P back-to-back 20+% gains, almost historical in and of itself. And then Trump came in and markets crashed, right? I think Trump's got a bigger ego than that. I think Trump wants to leave a different legacy than that. And that's why I do think right now is an opportunity in markets, since we have swung so far to the bear side. So I actually think a reversal in markets could come pretty soon. January 20th is going to be a big date, and I think next week's CPI report is going to be a big date. If we don't hear anything on tariffs on January 20th, then it's going to be more of a wait and see approach. We're going to be very sensitive to the tariff headlines that come out, But I don't think, generally speaking, tariffs are going to be as negative as Wall Street expects. Just imagine a scenario that inflation comes in around expectations or on the low side next week, and we get specific tariff announcements from Trump that are really not as bad as we expect. 10-year Treasury yields are going to plummet. Okay, that is what is going to be the trigger to cause a reversal in our markets, to cause Tesla stock to move higher again. Okay, I think it has to do with 10-year Treasury yields. Now, 10-year Treasury yields below 4.5%, not really a huge issue. But as 10-year Treasury yields get close to 5%, it's the velocity of the move higher. It's only been a couple of days that yields have broke above 4.5%. Now they're at 4.76%. People are like, oh my gosh, if we get a hot CPI report, if Trump tariffs are too aggressive, people start to speculate that 10-year Treasury yields could go to like 5.5% or 6%. People go crazy with expectations. Okay, so if I'm correct and CPI is lower than expected next week, and Trump tariffs are not as bad as expected, you could see 10-year Treasury yields back down to about 4.3%, maybe even 4.2% in just the course of like a week or two. If that were to happen, that's really going to free up some room for markets to move higher. Now, if the CPI report is like really good or something, then obviously you're going to see more of a dramatic move higher in markets. But I think 3 to 6 months from now, we may be saying, inflation's continuing to make progress. The economy's holding up. I think earnings are going to come in good as well. We do have earnings that start next week, and I'll share that chart with you in just a moment. But I think we're also going to say tariffs were not as bad as we think. All of a sudden, we have a perfect cocktail for a very strong 2025. And I think that's ultimately what's going to happen. Okay, again, with the backdrop of Trump doesn't want to be the guy that ruined the bull market. I could be wrong on that, but I don't think that is what he wants to do, okay? Now, this week, you start off with some major earnings. On Monday, you have KB Homes. On Tuesday, you have Applied Blockchain, Applied Digital. On Wednesday, you have JP Morgan, Citi, Wells Fargo, BlackRock, and BNY in the morning. You have a couple names in after hours. Thursday, you have TSMC, United Health Group, Goldman Sachs, Bank of America, Morgan Stanley, US Bancorp, First Horizon, M&T Bank, and PNC that will report. Friday, you have SLB, Regions, Truist, State Street, Independent Bank, Citizens Bank. So lots of banks that are going to kick off earnings. TSMC likely to have strong earnings. Foxconn, which is kind of a competitor to TSMC, reported really good earnings. Revenue was up like 42% year over year. I don't think we have much to worry about with TSMC's earnings, but if earnings were to not be as good as expected or something, that would be a problem for markets. I think at this point where stocks are at, you're pretty well priced for a bad earnings season. So even okay earnings or good earnings, probably going to be enough to send markets generally higher. So again, just to summarize here, markets are in a weak place. We're already very, fearful and negative, and even the Fed is fearful about Trump tariffs that could cause inflation. If tariffs are not as bad as expected, if CPI comes in better than expected next week, all of a sudden we have a strong economy, inflation that's making progress, and tariffs that are not as inflationary as we expected, and that could very well fuel a pretty nice rally. Now, I'm bullish small caps, cyclicals, industrials, AI appliers, software, specifically AI appliers and software. I think that is a huge area of opportunity in 2025. Small caps, if 10-year Treasury yields really come down, if the bull case in my scenario is more or less, realized. I'm not as big of a fan of big tech. Some people ask why, and that's because big tech has really been the only area of earnings growth the past 2 years, whereas that's expected to not be the case. We're expecting to get a more broader based kind of earnings acceleration in our markets. And big tech is trading at very high valuations relative to their growth rates. If you look at a small cap or a software name that could be growing at 30% and Apple's grown revenue 5% in 3 years and they're trading at 30 times multiples, some of these software stocks are trading around the same. I mean, the software stock growing at 40% versus Apple that's grown like 2% a year on average the last 3 years is a lot cheaper than Apple, okay? So I think from a valuation growth perspective, they're not as attractive. Could they work? Could they do well? Of course. But I think there's better opportunities out there. And if I'm correct, we should be seeing the end of this sell-off here over the next couple of weeks. Now, if I'm wrong, though, markets are going to decline a lot. As I mentioned, this 200-day moving average on the S&P would be the level to be watching for, about 550. That would be about, a peak to trough decline of almost 9%. If things were to get worse, then you're going to fall to this 520 level, which served as an area of support back in August, right? If we go back to the August 5th, essentially lows around 506, that would be a decline of about 16.5% from the highs to the lows. That is possible if tariffs are worse than expected, if inflation is continuing to skyrocket, if the Fed gets even more bearish, right? And it could get worse than that if the Fed talks about like raising rates or something, but I think we're far from that. And I think the next couple of weeks are going to give us more confirmation in what direction we're heading in. I tend to be optimistic by nature. I think this is a great buying opportunity. I don't think Trump wants his legacy to be one of disaster and ending of the bull market and essentially to get shown up by Biden. I don't think that's the ultimate goal. I think Trump's goal is to do better than Biden, to have the stock market go up more than Biden did. Maybe that's a bad judgment call on my part. Maybe that's a wrong assumption from Mr. Trump, but that's kind of my opinion. So I don't think it's going to be nearly as bad as Wall Street is currently expecting, but hey, I could be wrong. Let me know your thoughts on that down below in the comment section. Ladies and gentlemen, have a fantastic rest of your weekend, and I will see you in the next one.